I've been trading pure price action for over 5 years now. And within those 5 years, I have learned that indicators is not the right way in order to approach the markets. Now, I've actually developed a negative risk reward strategy, and in this video, I'll teach you exactly how I and also my students are approaching the markets on a day-to-day basis, which led to all of the profits that you're seeing on the screen right now. Now guys, this is a lot of information, and if I don't see you taking notes, then you're probably not serious enough about actually learning this. Now, before we're going to start taking any trades, we have to understand a couple of key concepts in order to actually execute the trades. Now, the first thing is going to be the direction, and don't tell me that you already know the direction or anything like that, because it is not so obvious. Now, knowing where the current direction is and where the current market is going is one thing, but actually knowing where it's going to continue and if it's not going to stop right at the point where you're going to trade. So as an example would be, let's just say I'm about to take a long in here, simply because the entire price action is just going higher and higher. But how do I actually know that this is just going to be the end of the entire uptrend and now we'll just continue lower? So in order to avoid these mistakes, we have to understand how to actually identify the direction. Now, identifying the direction is of course by looking at the highs and lows. Now, an uptrend is of course when you have higher lows, such as in here, and higher highs. But this goes far more than just understanding that we have broken structure, so we might as well just continue to the upside. Because if you're going to look closely on the top left of your screen, you can see that we're trading gold. Now, as a general thing, fundamentally, gold is just trading onto the upside. No matter how you're going to twist it, even if we are just trading downwards for a couple of weeks, let it even be a year, fundamentally, gold is one of those pairs where you will go onto the upside no matter what. So that is the first thing that we are always going to keep in mind when trading gold. Always we are keeping it in the back of our head that eventually this pair is going to go for new highs. But this doesn't only go for gold. This is the same for ES, NQ, and basically almost every other indice that you can go for. Now for the direction, there's two things that you have to differentiate between. It's going to be the long-term buys and also the short-term buys. Now the long-term buys is, as I've said previously, we're just going to go on to the upside. But the short-term buys is actually identifying where we're going to trade for the day. Remember guys, we are day traders. We are not trying to catch a trade that is basically going for the entire year. Ideally, you want to be into the trade and also out the same day that you got into it. Now we are on the weekly time frame right now, and there's already something that you can spot and already build a little bit of a framework off from. Now, we have previously said that we're going to go onto the upside. I don't want you to be annoyed by this, but just keep that in mind. However, currently, as you can see, we have two basically weekly candles going onto the downside. So this is indication that perhaps we do have a little bit of a downtrend going on if we're going to go onto the daily 4 or 1 hour time frame. Because on the weekly time frame, this is basically fractal. If you're going to go lower and lower, this will be a little bit of a downtrend. Now this indicating to us that currently the direction is clearly onto the downside. Because if we're going to go onto the 4 hour time frame, what can you spot? That you clearly have an entire downtrend. So the current short-term direction is actually to go onto the downside. But this already leads us to our next step, which is going to be the location. Now, just a couple seconds ago, I've told you that we're going to go to the downside because we have these couple of candles going lower. This is a short-term bias, remember. But location plays a very big role. You can also replace the word location with basically context. The entire context is if you're going to compare this little bit of price action, which I've also made videos on, is actually established movement onto the downside. But there's two major reasons on why we are not going to trade onto the downside, but rather onto the upside, depending on how the price action is going to look like. Now the first thing is the very obvious, we are just trading higher and higher. So what is that indicating? This entire move is essentially just a pullback, nothing more and nothing less. But there's the next thing also, where is the entire pullback phase heading to right now? We are in an FEG. So as a general thing, now if the market is trending onto the upside, it will always, and by always I truly mean always, have a pullback. There's no such thing that price just continues going higher and higher. Now in the case where it actually does that, the longer a trade continues, the more likely it becomes that it's either going to fully reverse on you or at least have a little bit of a pullback. Now a major thing to look out in here, as general rule of thumb, is looking out for the premium to discount range. Now usually price always likes to revisit the premium to discount range. So if we're in the premium right now, which is the upper half of this entire Fibonacci, that eventually we'll go lower into the discount range. But this is where direction and location basically meet with each other, because if the direction and location aligns well, then you don't have to look out for something like this. We'll have this in future examples, and also when I'm going to execute trades, that I'm going to look out for either longing into a premium or shorting into a discount range. But for now, just keep that in mind that probably we will trade onto the upside. Now, what is that entire FEG telling us that I've marked out earlier? Essentially, what an FEG is going to act as a real support and resistance. Because how many times have you seen it? You had some kind of low marked out, you wanted that low to be held, but the next thing you know, the price completely ignored it, and after it has taken out that, it is trading onto the upside. This is essentially what is happening in here. Now, this is where quality of a trend plays a huge role. Now, if you're just having a trend like this, so you see, we're trending higher, then lower, we're not getting into the discount range of this entire price action leg. So let me draw it out for you real quick. We have now fallen back into it. And after that, what has happened? We have traded higher and lower again. So if you're going to take all of these price action legs, so from here to here, we have not traded into the equilibrium. If you're going to extend the entire Fibonacci, so from the lowest point all the way to the highest point, we've also not fallen back into it. Now, why am I telling this to you? That means that basically the entire price action currently is not efficient enough. So just taking a trade based off what we have just seen is not going to be enough, guys. This is not going to cut it. So pairing it with an FEG is going to tell us that this is an actual level where we're probably going to hold and then trade onto the upside. So from here on, we want to drop down onto the daily time frame. Now keep in mind, we'll not do the entire analysis for every single trade that we're going to take in here, but it's important to understand it, especially if you're just new to trading. But even if you're not new to trading, having a look on the higher time frames is always going to be essential. So I've removed the entire pullback. I hope you can remember that this entire price action move on the weekly chart was a pullback. Now there's even more information that we're going to get in here. Now first of all, we have taken out liquidity. Now this is a liquidity run. However, this is the point where you have to be a little bit more specific, because if I'm just going to say that this is a liquidity run, then this is going to get very subjective. Why? Because essentially every single high or every single swing low that has been taken is a liquidity run. So if we're just going to extend this onto the chart and look out for every single high and every single low that has been taken out, then you'll just get crazy. You'll be start thinking, well, how do I know which liquidity rate actually counts? And this is where we're going to get into the specifics of this entire price action move. So I'm going to mark it out that this is the FEG on the weekly time frame. And I'm also going to mark out this little bit of price action in yellow. Now, and if I'm going to zoom in, there's a lot of information just on the daily chart alone that you have been missing all along. Now, first of all, the reason why this liquidity rate is more higher probability just on its own is simply because the difference between the previous one and the current one is that notice how this entire candle displaced heavily onto the downside. So basically, if you're going to see it in a reference point, this entire candle had more movement, more people to actually selling the markets than the previous 1, 2, 3, 4, 5 different candles. That is information. That is not just a candle that is just trading heavily onto the downside. That is telling you that sellers are heavily strong in that specific period of time. But what has happened next? This next candle has taken out its previous candle low and immediately shot up onto the upside. Now this on its own would also not tell you much if you didn't have the previous context of this entire candle taking out the previous candles. So this is also telling us that although we had strong movement onto the downside, we immediately shot up. So there was some kind of reason, and you don't even have to understand what reason it was. So if you're going to go low onto the time frames, eventually you will see some kind of order block that the trade has retraced back off from. So make sure to not do that. If we're going to go onto the 1 hour time frame, I guarantee you will find some kind of reason, whether it's going to be an FEG, an order block, a rejection block, whatever it's going to be at the end of the day, you will find something that the price has basically retraced off from. But don't do that, as this is very subjective. You cannot tell what exactly it was. So look at the actual price action, what the price is telling you, and not speculate on why price has moved in a certain way. Look at the very recent price action, especially if you are on the higher time frames, such as in this case on the daily time frame. So in here, price has showed up, buyers are in control now. Next candle was an indecisive candle. We're not going for the high, also not for the low. Why do I know this? Because this candle high and also this candle low were not taken out by this point of time. The next candle is pretty much our confirmation. This is where a lot of people will get pretty confused because they might be saying, well, this is an indecisive candle. Why is this candle so more significant than everything that we have seen previously? Now, most traders would actually take a long ride in here. Why? Because they are just seeing strong willingness to go into the upside. But they would have been, of course, stopped out. So with the entire system that I'm going to show you in this video, we're just one step ahead of everybody who would have traded a long in there. Why is this liquidity run more high probability than this one? Well, simply because we have already seen buys are in control now. We were not able to displace lower and lower. But this entire candle, remember guys, I have told to you, is telling us that it's indecisive. But we have also taken out the low of this entire candle. So basically try to see in 3 simple steps. This entire candle was fueled by sellers. This entire candle was fueled by buyers who basically didn't want to give up on their position and basically bought the price back up. This candle is an indecisive candle, but this is the key candle. It took out the liquidity that has been building up between these 2 candles, and now this entire liquidity run becomes more high probability. So I'm going to remove a couple of things. Now we understand that this liquidity run is the one that we actually want to count on. We have to find additional information. Now, if we're going to extend this entire line from left to right, then these are going to be relative equal highs. Now, what are relative equal highs in case you don't know? Now quickly, it's when you have 2 swing highs or swing lows that are relatively equal close to each other. You see how this high is close to this one? That's why they're called equally close to each other. Now if this entire swing high would be in here, they are not relatively equal close to each other, therefore they are not relative equal highs. So in here we're going to drop down onto the 4-hour time frame and look out for more information. Now we had this entire liquidity run onto the downside, and we also have these entire relative equal highs. On the 4-hour time frame, we even have more uncleared liquidity. Now remember guys, the entire market consists of liquidity that has not been taken out yet. So these highs are just essentially reasons to go higher onto the upside. Now most people now will trade this all the way onto the upside. Why is this wrong? Simply because you are trying to basically ask the market to be completely perfect. And that is basically the rule number 1. Don't try to be perfect. This is an unwritten rule that I give everybody who is asking for trading advice. Of course, try to predict the market as well as you can. Try to time it as well as you can, but don't try to basically top or bottom tick. It will destroy you. Now, the next unwritten rule is don't make it too complicated. Now, we have already done so many different analysis. We don't want to further overanalyze the chart. We have had our liquidity run. We had the direction of the chart, the locations, so the point where we currently are, and now we are just looking out for criteria. But don't make it too complicated and don't overanalyze. I'm a trader trying to make it as simple as possible. So in here, what we basically want to do, on the 1-hour time frame, we want to wait for the 0 AM candle closure. Now, most of you guys are trading New York open. The problem with that is, especially when I was just working a job, I was not able to actually trade during the New York session or the London session. Because when I was working a job, I couldn't trade. So I had to implement something in my trading that was working any time of the day. This session that I'm giving you in this video, which is a customized session only for negative risk reward traders, is just made to catch the highest probability setups. But in theory, you can trade the strategy at any given moment, simply because you already expect getting into a drawdown. But in this one, we're going to keep it very mechanical. So we're basically at the 0 AM candle, and from here, we want to take a market order. Now, most of you guys, the number 1 mistake that I see everybody making when trying to trade my strategy, they are trying to go for this high, which is basically the internal relative equal highs, or the external relative equal highs. That is the biggest mistake that I've seen everybody making when trading my strategy. Firstly, you don't want to shoot for high profit targets. You want to be into the market and out of it as soon as possible. So you're not going to trade all the way to these highs. Rather, you want to look for the lowest hanging fruit. The lowest hanging fruit is the easiest target that the price can reach into. In this case, it is the most recent swing high that has been created onto the chart. Now, for anybody that is not seeing it, this is an actual swing high. The candle in the center is higher than the left one of it and also the right of it. So this is going to be our take profit. Now, what do you think our stop loss is going to be? Of course, we're going to put it at the liquidity rate. Now, the liquidity rate has actually 2 purposes. First of all, in order for the market to go in a certain direction, it has to take out the opposite direction of market participants. Now, how is that looking like? Basically what we have in here. I'm going to simplify it for you even further. So while I'm going to draw it, I'm going to explain it to you. So in a bullish market, right? In order for the price to go higher, we need to take out fuel. So this is the exact point where we have taken out fuel in order to then trade higher. Think of it as like a car. A car doesn't run if you're not going to put fuel into it. The same for a downtrend. In order for the price to go lower, we need to take out fuel onto the opposite direction, so basically trading higher, so then we can trade lower. That is the purpose number one of this entire liquidity rate. Purpose number two is that we are also currently in an entire FEG. So the FEG is also going to support the entire bias. So in here, this is going to be the entire trade that we're going to take. This is the first trade, and this is a straight take profit hit. Now guys, quickly, if you're having problems passing your prop firm challenge, then I will pass it for you risk-free. In the case where I don't pass your prop firm challenge, you'll not only get the money back that you have paid me, but you'll also get the money back that you have paid the prop firm in order to get the challenge. If that sounds good to you, it's in the description down below. This is exactly what I'm telling you. You have to stick to this exact timing of the market in order to make the best out of the strategy. I'm going to show you another trade example in this entire backtesting session, but you have to understand the best trade, and this is actually more important than taking a trade. However, you need to understand this. It is good to know when you're going to take a trade. It is absolutely necessary in order to trade. However, it is even more important to know when not to trade. If you don't know the exact criteria when you're not supposed to take a trade, then you'll just get stopped out after getting stopped out, and you will not be able to achieve a 95% win rate like me. The reason why I'm able to achieve this high of a win rate is because I know when not to trade. So if you're going to miss this part of when to not take a trade, then expect the strategy to not work. But in that case, also make sure that you have not learned it from me, because otherwise people will be thinking that I taught this. So I'm quickly going to skip on to the next day, as we have already taken an entire trade on this one, and we want to trade the next day basically. So this candle has almost closed, and we're not going to change much from here. So now I'm going to show you how to avoid the bad trading days and when it's best to just stay out of the markets. Now in here, are we going for the previous day high or for the previous day low? Now, if you have seen my previous videos, then you would have said that, well, we are going to go for the previous day high. Why? Because this is essentially just established movement if you're going to compare these two candles. We were not able to displace lower, but we're actually able to displace higher. So clearly, we're probably going for the previous day high. Now, and if I'm going to be honest with you, probably this will actually go for the high, but just because I have a systematic reason on why to not take a trade this day, I'm not going to take it. Now, the reason number one is simply because previously, what have we seen on the 4-hour time frame? On the 4-hour time frame, we have already taken out these relative equal highs. So that is indicating to us that probably the liquidity is already over. Now, this is basically the same that I've told you previously. In order for the price to go higher, it needs to go lower first. Now, I hope that I'm not making it too complicated, but bear with me on this one. Essentially, this is the same that I've told you previously, but just as a bearish example. So once again, speak with me. In order for the price to go higher, it needs to go lower first to take out fuel, and then it can basically continue going higher. So understand this logic. We have taken out liquidity onto the upside. So now it's time to basically take out the opposite direction. So basically lows, and then we can continue higher. So what the usual guy would do, especially that is trading my strategy or just any system, he would be saying that, okay, we'll go for the previous day high, because we are already trading onto the upside. And not to mention, they would also go for 1 for 10. Remember that, right? But we're going to do complete opposite. From here, we will drop down onto the 1-hour time frame and look out for more reasons on why this is actually not a high probability day. Now, to be honest with you, most reasons were already identified on the daily time frame alone, that this is not a high probability day. Essentially, what is the key point of not trading is this relative equal high. But can we spot more things? Yes, we do. Now, on the 1-hour time frame alone, there is basically inefficiency in the entire market. Price has not turned into these FEGs. Now previously I've said to you that you like to trade into the FEGs, and then from here on you want to trade away from it, basically using it as support and resistance. Now in some cases, such as on the weekly time frame, that is a different story, because the entire context was aligning pretty well. In this case, it is not the same, because that would also mean that we're going to get into an efficient market in that case. And if it's going all the way lower in here, it might as well even go for that low and continue for one more stop rate until it actually continues higher. So we're not going to risk it in this case, and rather we'll just avoid taking this entire trade altogether. Because my philosophy about FEGs is that we like to trade into the FEGs and not away from them. And once again, on the weekly time frame, it's a different story. It's a higher time frame objective, and we're also just trading onto the upside. So the
likelihood of it being support or resistance is higher than actually trying to trade into it. So we're going to avoid this entire day altogether. Now, would you look at that on a daily time frame, we have actually not traded into the previous day high. Once again, we have taken out liquidity onto the opposite direction, so most likely we'll also not continue higher. But what else is there? I've spotted previously onto the 1 hour time frame, but you can also take the 4 hour FEG in this case. As you can see, we have traded into it. One more indication that price was not willing to go higher yet. It has already taken out the liquidity, guys. This is what I'm trying to teach you here. And you see how basically if you're going to avoid the trap, the market will reward you. Because if you're going to look closely on that, so let's just say on the 4 hour time frame, what has the market formed in here? What can you see? That's basically similar to this entire price action move, just like in here. Do you see it? Because right in here, we have more relative equal highs created. So this is very important. If you're just going to avoid these traps, the market will reward you after that because it has to generate liquidity one way or the other. So what can we see with external relative equal highs and also internal relative equal highs? So ideally, you always want to look out for internal relative equal highs and also external relative equal highs. The take profit is most of the times neither of those, but if it's going to be one of those, then it's always the internal relative equal high and rarely ever the external relative equal highs. So once again, the market has rewarded us for just staying patient. Now we're going to go onto 0 AM. So basically our standard session that we want to take a trade on. And from here, we want to take a trade onto the upside. Now I've told you previously, you want to go for the lowest hanging fruit, which would be this high. This is basically the last swing point that has been created before we actually trade it onto the downside. So this is an entire price action leg. However, in this case, this is where you can actually maximize profits. Now look guys, I'm not against just maximizing your profits. I'm just here to actually tell you how to have the highest possible win rate out of any other trader. Now in this case, we actually want to trade into the internal relative equal highs. Now why? What is the reason why previously we were not able to trade into the internal relative equal highs, or let alone the external relative equal highs? We don't want to do that, but in this case we are. Simply because we are just so close onto it. If you are so close onto a profit target, then it's actually worth it to aim for that, simply because it's just so close. The likelihood that price is just going to basically do a 180 on you after going into this high and then trading all the way lower is very unlikely. So you might as well just keep your entire take profit into the internal relative equal highs. Now stop loss placement, that is the most important part out of everything. You don't want to lose the entire equity on the account, of course. Your stop loss is going to reside at the previous liquidity run. Simple as that, guys. I don't want you to overcomplicate it. A liquidity run means a lot in this way of trading. Now this will not work every single time. This is just an example where we are just very close onto it. If price has moved all the way higher, so somewhere in here at some point, then of course this liquidity run does not play any role anymore, because then you would have to repeat the entire process again. Trade lower, do a trap in that sense, trade higher again, take out this liquidity, and then you can trade onto the upside. But since we're just so close onto this entire liquidity run, we can just put our stop loss right in here and make it very easy on our psychology and just have a very easy life in that sense. So this is not a take profit hit, clean price delivery. Now of course the previous trade was straight into our take profit. This one was more of a little bit of a runner because we traded higher, traded back into the drawdown, no problem, stick to the buys and then higher. Now a lot of people would be saying that you went barely into any drawdown. Why was your stop loss not anywhere in here? This is where a lot of different traders are just basically going to mess up. When you're going to trade my strategy, you're going to get a couple of these trade examples where you didn't get into any kind of drawdown, and then straight away you'll be thinking that, okay, I'm just going to trade just like that. I'm going to put my entry right in here and stop loss as minimal as possible. That will happen to you a couple of times. But just as many times or even more times you'll be stopped out doing this. Now there's actually a logical reason on why you should not do this kind of stuff. Because we have this entire 1 hour FEG. There is still potential for this entire price to go onto the downside, fill out the FEG and only then trade higher. So why risk it? Once again, having this high of a win rate requires you to actually stick to the entire analysis and info that I'm giving you in this video. Now, this is basically the case where a bunch of different traders are also going to fail. Why? Because on the surface, this is looking very obvious, right? We are probably going to go to the previous day low and not for the previous day high. Why?
because we have established movement onto the upside, you might be saying. But there is one major problem for all of this. Now, first of all, we are actually trading onto the upside. This candle is not enough of an established movement onto the downside because it is basically just engulfing, or not even engulfing, the previous candle, and that's about it. Now, the next thing is also price had a reason to go lower in here. If it didn't have no reason, now quickly guys, over the years I've most likely tried every single journal that is out there, but none of them has actually come close to what TradeLens is going to give you. TradeLens has an integrated AI assistant which is going to help you further analyze and understand your trading behavior. I'm using it myself, and if you want a 10% discount on every single purchase, the link to that is in the description down below. Then you might as well just consider this to be the start of a bigger move. But in this case, we actually had a reason on why to trade lower. And as simple as that, it is this entire daily FEG. So that is telling us that price had an actual reason to trade lower, which also means that essentially these two big candles onto the upside is already a uptrend if you go into the 4 or 1 hour time frame. And this entire thing is simply just a pullback. How many times have you seen it? You are trading lower, falling back into an FEG and breaking another low. This is essentially what happened in here. Broken the structure, going lower, basically this is the entire pullback, and then from there on you can expect higher prices. And you might be saying, well, since you know that we're going to go higher, let's take a trade, right? Let's trade all the way to the previous day high and not to the previous day low. But this is where you're going to be completely wrong. We have no confirmation that this is going to happen right now. So we basically need another established movement onto the upside, and then from there, so I basically skipped the entire candle, we can already build another framework. Now this is actually what has happened, and now this entire candle is not the previous day high anymore, but essentially it is going to be this one. Now I am going to drop down onto the 1 hour time frame and basically skip a little bit more of the day, so the next daily candle is going to open such as in here. And you might have guessed that this is basically a repeating pattern. Over and over again we're doing the same thing in here. Now what can we spot? Are we going for the previous day high, or are we more likely to go to the previous day low? Now in that case, it is basically a no-brainer. Of course we are going to go for the high, because what else can we spot on a daily chart alone? These two candles are going to be what? Relative equal highs onto the lower time frames. This is just out of experience that if you have two candles basically being relatively equal, then if you go into a lower time frame, those will be relative equal highs. Now in the case where you might be saying that, well, but this is no swing high, if you're going to go lower and lower, eventually you will find a swing high in there. So in this case, where are we more likely to trade in? Now granted, I also want to educate you about reasons on why the trade could also fail. Because if you're just going to look out for reasons on why the trade is going to basically hit your take profit, then this is a pretty bad practice, because you have to understand also the ups and downsides of every single trading decision. I am going to remove the entire previous trade that we have taken. So in this case, since we also have liquidity onto the downside, it is not dumb for you to say that, okay, we might as well just push lower. However, just given the entire context, if we're going to go into the 4 hour time frame, this is just a massive uptrend. Now, I don't want you to look at everything that has happened beforehand. Keep in mind, we're still in FEG in that sense. I just want you to look at what has recently happened. Higher highs, higher lows, what is that? An uptrend. Simple as that. So we want to trade into either the previous day high or into the relative equal highs. Now, in cases like these, I heavily recommend putting your stop loss into the previous day low. In this case, since this entire swing low and also this candle low is just very close by, we are going to refine our entire trade, so we're going to squeeze out even more profits. In this case, since we are pretty sure that this high is going to be taken out, because this is basically the next liquidity that we want to trade into, we simply can actually go for the relative equal highs as a take profit instead of just going for the previous day high, as just going for the previous day high will not be enough of a profit. Now, of course, we're trading in negative risk reward, but we don't want to take it into an extreme level where we're basically just going for pennies at that point. So keep that in mind. So now we'll drop down onto the 1 hour time frame. We are already at the 0 AM candle, which is actually in here. I've just readjusted it, and from here we simply want to take the position. Let's see how this is going to go, and that's a take profit hit. Now surely the trade is overshooting our entire take profit by quite a bit, but once again, If you're not going to stick to these rules, you'll find yourself having a lot of these trades just running into your take profit and then immediately into your loss again. So trade safely with a low risk to reward. So I am going to remove all of these things because if you haven't noticed it yet, I like to keep my chart as clean as just possible while also not missing out on valuable information. Now let's look basically onto the daily time frame, onto the 4 and 1 hour. And I've already seen that on the 4 hour time frame there is actually something that you have to pay attention to. On the daily time frame alone, we have just pushed higher, have taken out this entire swing high, which is actually a swing high onto the daily chart, and that is basically about it. Have traded into the FVG and higher. There's not much else to say in that case. However, on the 4 hour time frame, what can we spot? If you're going to look right to the left, what can you see in this little bit of price action? Just out of the top of your head, name me every single thing that you can see right in this little bit of price action. Now, I am not going to keep you waiting for too much longer. We have an entire gap in here. That is essentially the entire point that I'm trying to make. Gaps like to be traded back into with a full body closure, which has actually happened in that case. But what else do we have? These are all relative equal highs. So most likely we will actually trade into that, right? So why have I not marked these relative equal highs beforehand when we were just in that little bit of price action? Now perhaps I have marked them out or not, but the reason why they don't matter to begin with, even if I'm marking them out, I'm just showing it to you and presenting it to you, but they have not mattered at that point in time. Why? Simple as that. The chart is just way too far away from all of this liquidity. You only care about liquidity that is actually nearby. Don't zoom out of the chart and see, well, we have liquidity in here. That doesn't matter anymore. We're just trading higher and higher. Can't you see it? So we don't really care about what is all the way onto the bottom there. We only care what is the recent liquidity that is very nearby. So in this case, we're still not quite close yet, but we are approaching it. That is the reason why I've marked out the relative equal highs now. So I am going to go into the 1 hour time frame and basically skip a couple of different candles. So the next day is going to open. Now onto the daily time frame, we have actually taken out the previous day high. So essentially that is already no trading day for us. We can't really build a framework from. Yes, we might as well just go into that entire FVG, trade lower and then higher, but we don't want to risk it. We actually just want to stick to the rules that I'm giving you in this strategy. I'm going to remove daily and also the weekly time frame. So we're essentially just going to skip this entire day, as this was no potential trade entry for us. Onto the daily time frame, I've skipped the entire candle and we have just basically pushed onto the upside. So once again, we have pretty much avoided that entire trade. Now I've previously said that probably we will actually go onto the downside. This has not happened yet, but have I taken a trade? No, that is the most important part. Even though you were wrong in the direction, what matters most is, have you taken a trade or not? Simple as that. So we have basically skipped on to the next day and see how this is going to look like. This is one of those trades where it's just very obvious. Now remember, this is on the 1 hour time frame and this currently is the relative equal highs that we had on the daily time frame. Now I don't even have to go into the daily time frame for weekly, monthly. We're going to keep it very simple for this last trade that we're going to take in here. Simple as that. What can we see? We have an entire gap that we have not traded into yet. Now you might be saying that, well, this entire candle has traded into it, but we need to completely fill it out with a body closure. So we would have to go at least to the low of this entire gap in order to then trade higher. So in that case, that is telling us that this is a potential trade entry. So we're going to place it right in here. Now to take profit could potentially be the previous day high or the previous day low, which is right in, or the previous day low, which should be right in here. Now, but obviously, if we're going to extend our entire stop loss into here, this is a 0.2. Well, you don't even have to go for this entire low. I don't think that price is just going to return all the way to the previous day low. If we're actually right on the trade, price wouldn't have to move all the way lower in there. Now, a potential take profit could be the relative equal highs in here, but that is not even necessary. We are already refining our entry and we're not shooting for a very massive sort of risk reward in that case. So we're even going to extend our entire stop loss right into here. Why is that? Why is it that exact candle? Because essentially this entire FVG is the last form of protection, right? So this is why the entire stop loss is sitting right below that 1 hour FVG, because you have to see it this way. So this FVG and also this FVG and everything that is basically below your entry is supposed to protect your position. So this could be a protection point, this one, and the FVGs, and then eventually if you are truly just wrong into the trade,
it will just hit a stop loss, and that is what it is. So from here on, we want to see if we're going to enter into the trade or not. So as you can see, we have actually been entered into the trade, and this is a straight take profit. Now once again guys, this works very well. We have entered the trade and also been out of the trade the same hour. However, you will also have price action where we go right in here and then higher. Now in this current backtesting session, we didn't really have a lot of examples where we went into a drawdown. This is why you're going to click on this video, because this is going to explain to you how to manage those drawdowns. And in this entire backtesting session, I've actually taken a loss to further show you how to analyze the markets correctly and to avoid these kinds of losses potentially. Now, if you have watched up until this point and you still haven't clicked on the video that is on the screen right now, then like the video, subscribe to the channel, and if you have any questions regarding to the strategy, then leave them down in the comments. I will answer, I promise. Thank you guys for watching, see you in the next one.